Welcome, curious minds, to The Deep Dive, your go-to source where we cut through the noise and deliver the critical insights you need to stay truly well-informed.
Yes, welcome.
Today, we're embarking on, well, a crucial journey through the financial landscape of July 2025.
And our mission today is really to distill the most significant financial news of this past month. We've pulled together a pretty comprehensive collection of reports and analyses, and we'll extract the key takeaways, try to unravel some of the complex terms, and really connect the dots.
So you gain a clear, engaging, and insightful understanding of what's shaping the financial world right now. Think of this as your essential briefing.
Exactly. Your shortcut, maybe.
This deep dive will navigate everything from new investor protection campaigns, significant banking system reforms, all the way to breakthroughs in digital payments and major shifts in market regulations.
Yeah, it's been a month absolutely packed with changes, a lot designed to enhance stability, efficiency, and, importantly, investor confidence across the board.
All right, so let's unpack this. We've thoroughly reviewed the financial news document for July 2025, and it truly is a dense but fascinating collection of developments.
It really is. So what immediately strikes you as we begin this dive? Anything jump out?
For me, it's the clear and proactive stance being taken towards reinforcing investor protection and strengthening the fundamental health of our financial markets. It feels like a very deliberate, concerted effort to build trust in the system.
I agree. And that takes us directly into what we're calling Section 1, investor protection and market health.
Right.
It's where we see the groundwork being laid for, hopefully, a more secure financial future.
Absolutely. We kick things off with a crucial initiative for individual investors. The Investor Education and Protection Fund Authority, or IEPFA, launched its Saksham Niveshak campaign. So what's the core purpose behind this campaign? What are they trying to achieve?
Well, this campaign is a direct push to empower shareholders. Its primary goal is to help them claim unclaimed dividends and ensure their KYC, that's Know Your Customer Information, essentially your identity verification, and also nomination records are fully up to date.
And it's overseen by the Ministry of Corporate Affairs.
Yes, that's right. Overseen by the ministry, which signals its national importance.
That sounds incredibly vital. But for anyone who might not be familiar, what exactly is the IEPF and, where do these unclaimed funds typically originate?
Right. Good question. The IEPF, or Investor Education and Protection Fund, acts as a significant financial safety net. It was established under the Companies Act way back to collect various amounts that remain unpaid or unclaimed for 7 consecutive years.
7 years?
Yeah, 7 years. And this includes quite a range of funds. Unpaid dividends from company accounts, application money for securities allotments that were due for a refund, matured deposits and debentures held with companies, and even the interest accrued on these amounts. It also receives grants, donations, and, interestingly, income from its own investments.
So it's a centralized pool for various forgotten or lost funds. Once these amounts are credited, how is the fund actually utilized? What happens to the money?
It serves several critical functions. Firstly, and most directly, it refunds those very unclaimed dividends, matured deposits, debentures, application money, and the interest back to eligible individuals who actually come forward to claim them.
Okay, makes sense.
Secondly, and this is where the Saksham Niveshak campaign really fits in, it actively promotes investor education, awareness, and protection.
Right, the educational piece.
Exactly. Thirdly, it distributes disgorged amounts, that's how amounts recovered from wrongful actions, to shareholders, debenture holders, or depositors who have suffered losses, as ordered by a court.
Okay.
And finally, it covers legal expenses for class action suits, as sanctioned by the tribunal, and other incidental purposes. And there's always a provision for refunds of amounts transferred even after the 7 years.
And the IEPFA itself, the authority managing all this, when did that come about?
The IEPFA, the authority, was set up more recently in 2016, also under the Ministry of Corporate Affairs, headquartered in New Delhi.
Okay.
Its sole objective is to manage the IEPF, specifically focusing on safeguarding investor interests by facilitating the refund of shares, unclaimed dividends, and those matured deposits or debentures.
So this campaign is a direct result of that mandate?
Precisely. It's a direct action stemming from that core mission. A clear example of government bodies proactively working to ensure investors don't lose out on their rightful funds.
That's a fundamental step for individual financial security. Turning now to a different facet of security, The Reserve Bank of India, or RBI, has advised all banks to integrate something called the Financial Fraud Risk Indicator, or FRI.
FRI, yes.
Why is this in the news now, and how will it combat the ever-growing threat of cyber-enabled financial frauds?
This is a crucial, proactive step in the ongoing battle against digital fraud. The FRI itself was developed by the Department of Telecommunications, the DOT, and its integration allows for real-time data exchange between banks and DIGOT's Digital Intelligence Platform, or DIP.
Real-time data exchange, okay.
Yes, and here's where the system truly gets clever. The FRI leverages inputs from a wide array of sources. It pulls information from the Indian Cybercrime Coordination Center's National Cybercrime Reporting Portal.
I4C.
Right, exactly, I4C. Also, the DIT's Chakshu platform and intelligence gathered from both traditional banks and non-banking financial companies, NBFCs.
So it's about fusing intelligence from multiple agencies and financial players to create a stronger defense, pooling resources, essentially.
Precisely. Based on all these diverse inputs, mobile numbers are dynamically classified into risk categories: medium, high, or very high risk, depending on their aggregated fraud profile. In addition, a mobile number revocation list, or MNRL, is actively shared with banks.
MNRL.
Yes, the MNRL. This list includes numbers that have been disconnected due to confirmed involvement in fraudulent activities or misuse.
So numbers known to be bad actors.
Exactly. This allows banks to be incredibly proactive in identifying and flagging potentially fraudulent transactions or accounts. The practical upshot for you, the listener, is enhanced protection against common threats like phishing, scam calls, and other sophisticated cyber-enabled financial attacks.
So hopefully fewer scam attempts getting through.
That's the goal. It's a significant move towards a more secure digital banking environment, aiming to intercept fraudsters before they can cause widespread damage.
That's an impressive display of interagency data fusion. This proactive approach seems to be a running theme.
It does seem that way.
That takes us into Section 2, strengthening the banking system, where we have some genuinely positive news regarding the health of India's public sector banks.
Indeed, it's a story of significant turnaround, which is always welcome news.
Their gross non-performing assets, or NPAs, have seen a remarkable reduction. What do the numbers tell us, and what key reforms contributed to this positive trend?
This is a very strong indicator of the banking sector's improving health. The gross NPAs of public sector banks have dropped substantially.
How much?
Dropping from 9.11% back in March 2021 down to a much healthier 2.58% by March 2025.
Wow, that's quite a fall.
It is. This nearly 7 percentage point reduction is directly attributable to a series of major reforms and robust mechanisms implemented over the past few years.
What were some of these pivotal reforms that made such a difference?
Well, one key reform involved raising the Debt Recovery Tribunal, or DRT, threshold.
The DRT threshold, okay.
It was increased from 10 lakh up to 20 lakh. Now, this might seem like a small change, but it allowed DRTs to focus their valuable resources on higher value cases.
Makes sense. Focus the effort.
Significantly expediting their resolution. Another absolutely crucial mechanism was the Prudential Framework for Resolution of Stressed Assets, issued by RBI back in 2019.
All right, I remember that.
This framework provides clear guidelines for early recognition of stressed assets, standardized reporting, and most importantly, a time-bound resolution process. It created strong incentives for lenders to resolve issues quickly.
We've touched on DRTs before. For our listeners, could you briefly explain what they are and why they're so vital in debt recovery?
Certainly. Debt recovery tribunals and their appellate bodies, the DRATs, were specifically established under the Recovery of Debts and Bankruptcy Act, 1993. Their core purpose is to provide quick and efficient adjudication and recovery of debts owed to banks and financial institutions.
So, specialized courts for debt?
Essentially, yes. This specialized system streamlines the often complex process of recovering bad loans, reducing the burden on conventional courts and accelerating financial resolutions.
And how did the RBI's guidelines on valuing properties used as collateral play a role in this NPA reduction? That seems important too.
Absolutely. The RBI also issued specific valuation guidelines that brought in greater transparency and, importantly, accurate risk assessment. For instance, properties valued over 50 crore now require 2 independent valuation reports.
2 reports, okay.
Yeah.
Adds a check.
Adds a critical layer of scrutiny, yes. Also, under RBI's income recognition, asset classification, and provisioning the IRASHI norms from 2015, banks must get immovable properties used as loan collateral valued at least once every 3 years by approved valuers.
Every 3 years?
Minimum. These guidelines ensure that the collateral backing loans is accurately assessed, providing a clearer, more realistic picture of the bank's true risk exposure.
Those are foundational changes for stability. Shifting focus now to the restructuring of regional banking. The government of India has significantly reduced the number of regional rural banks, or RRBs, under its one state, one RRB policy.
Yeah, a major consolidation effort.
What's the scale of this reduction, and what was the thinking behind such as, well, drastic consolidation?
It has led to a major consolidation, really streamlining the regional banking structure. The number of RRBs has been brought down from an initial 196.
Wow, 196.
Down to just 28 as of May 2025.
That's huge.
It is. The rationale was basically to create stronger, more sustainable regional banking entities capable of serving rural areas more effectively.
Did it work?
Well, research from both the RBI in their report on trend and progress of banking in India and a NABARD study in 2021 both highlighted that this amalgamation process significantly improved several key aspects of the RRBs.
Such as?
Specifically, it led to improved financial performance, enhanced operational viability, greater profitability and overall viability, and stronger leverage and reserves to capital ratios.
So the goal was stronger banks, and the data suggests it's working.
Exactly. The goal was stronger, more sustainable regional banking entities, and the data does suggest it's having the desired effect. For you, this means potentially stronger financial institutions serving rural areas, leading to perhaps more efficient and robust access to banking services there.
Okay, now for small and medium businesses, a new development from the Ministry of Finance could be a real game changer. A digital credit assessment model launched in March.
Yes, this is a big one for MSMEs.
What's the goal here, and how does it practically change the loan application process for MSMEs?
This model, which is actually announced in the Union Budget 2024-25, is a true potential game changer for MSMEs. Its primary goal is to digitize and streamline loan assessments, moving away from relying solely on external, often paper-based assessments.
Right.
Public sector banks are now using digitally fetched, verifiable data for MSME loan processing. This digital approach is designed to make the entire process faster, more transparent, and ultimately more accessible for small and medium enterprises seeking capital.
So it benefits both new businesses trying to get a loan and existing customers.
Yes, exactly. The model supports both new-to-bank, or NTB, and existing-to-bank, or ETB, MSME borrowers.
And the features, how does it work?
The model's features are quite innovative. It uses mobile and email verification via OTP, standard now, but also analyzes bank statements securely through account aggregators.
Ah, the account aggregator framework.
Precisely, allowing for secure, consent-based sharing of financial data. It pulls comprehensive credit history via credit information companies, or CICs, and incorporates robust fraud checks.
All digital.
All digital. This comprehensive digital approach should significantly reduce the time and, frankly, the effort MSMEs spend on securing loans, making it far easier for them to access much-needed capital to grow their businesses.
This sounds like a foundational overhaul. The Ministry of Finance announced that key provisions of the Banking Laws Amendment Act 2025 will come into effect from August 1st, 2025.
Yes, this is a big piece of legislation.
What's the biggest implication for how banks operate? What's the headline here?
This is indeed a monumental shift. The Banking Laws Amendment Act 2025, which was notified back in April 2025, is incredibly comprehensive. It covers 19 distinct amendments across 5 fundamental legislations.
5 acts, wow.
Yes, including the RBI Act of 1934, the Banking Regulation Act of 1949, the State Bank of India Act, and the Banking Companies Acts of 1970 and 80.
So a real overhaul.
It is. The real insight here isn't just about modernizing laws, though that's part of it. It's also about shifting the levers of power and subtly rebalancing governance within the banking sector itself.
Okay, that's a lot of ground covered. What are some of the most impactful changes we need to understand from this act?
Well, one significant change aims to redefine substantial interests for directorships. It potentially raises the threshold from 5 lakh up to 2 crore.
From 5 lakh to 2 crore, that's a jump.
It is. Currently, under the Banking Regulation Act, substantial interest refers to holding shares of over 5 lakh or 10% of the paid-up capital of the company, whichever is less.
Okay.
By raising this financial threshold, the Act changes the criteria for who's considered to have significant influence, which could potentially broaden the pool of eligible directors.
So a subtle but significant change in who can sit on bank boards and shape decisions. What about other changes?
Another crucial change relates to the tenure of directors of cooperative banks. The bill proposes increasing the maximum consecutive tenure for directors, excluding the chairman or whole-time director, from 8 years up to 10 years.
Aligning it with the Constitution.
Yes, aligning it with the 97th Constitutional Amendment. The intention here seems to be to bring more stability and continuity to cooperative bank boards, allowing for potentially longer-term strategic planning.
And does this act tie back to the unclaimed funds we discussed earlier with the IEPF? Is there a connection?
Yes, absolutely. It ties back directly. The bill significantly expands the types of funds that can be transferred to the Investor Education and Protection Fund, the IEPF.
What new types of funds?
This now specifically includes shares for which dividends have not been paid or claimed for 7 consecutive years.
Right, we mentioned that.
And also unpaid or unclaimed interest or redemption amounts for bonds. The important point, though, is that individuals can still claim these transferred amounts from the IEPF. It reinforces the fund's role as a protector of investor assets.
Good to know. And what about auditors? Does their selection and remuneration shift under this act?
Indeed it does. The bill grants banks the authority to decide the remuneration of their auditors.
The banks decide now.
Yes, a power previously held by the RBI in consultation with the central government. This change gives banks more autonomy and, presumably, control in managing their auditing processes.
Okay. Any other notable changes?
Yes, a few others worth mentioning. It proposes increasing the nominee options per bank account from just 1 currently, up to 4.
Oh, that's useful flexibility.
It is. Also, regulatory reporting dates for banks are proposed to change to the 15th and the last day of each month,
Instead of Fridays.
instead of the current system of the 2nd and 4th Fridays. The aim seems to be more standardized and predictable reporting cycles.
And a very technical, but I guess important change for cash reserves, redefining a fortnight. How does that simplify things?
It's a quiet but effective way to simplify compliance, I think. The bill redefines fortnight for cash reserves under the RBI Act from a slightly odd rolling period.
Right, Saturday to the second Friday.
Exactly, to a straightforward calendar period, either the 1st to the 15th of the month or the 16th to the last day. Much simpler. This change also applies to the Banking Regulation Act for non-scheduled banks. And finally, there's an amendment regarding common directorships in cooperative banks. It extends an exemption, allowing directors of central cooperative banks to serve on the boards of state cooperative banks where they are members. This is similar to the exemption already granted to RBI-appointed directors.
So, quite comprehensive.
Very. These changes collectively reflect a concerted effort to modernize and strengthen the legal framework governing banking in India.
Fascinating detail on those foundational shifts. Now let's pivot to the dynamic world of digital payments in India. We have some truly impressive figures regarding transaction volumes.
Yes, the scale is quite something.
What's the sheer scale of this transformation we're seeing?
The numbers are genuinely jaw-dropping. They showcase an explosive growth in digital transactions right across the country. Between the financial year 2019-20 and 2024-25.
Oh.
Get this.
Okay.
India has recorded over 65,000 crore digital transactions.
65,000 crore.
Yes, amounting to more than 12,000 lakh crore in value.
That's just enormous.
It's a massive shift in how transactions are being conducted, rapidly moving towards a, less cash economy.
And the RBI has a specific way of tracking this impressive growth, right? The Digital Payments Index, the DPI.
That's right. The RBI-DPI was created precisely for this, to track the digitization of payments in India, with a base year of March 2018 set at an index of 100.
Okay, 100 is the baseline.
The latest index as of September 2024 stands at a robust 465.33.
Over 4.5 times the base in just over 6 years?
Exactly. It clearly illustrates the strong and sustained digital growth in payment adoption and infrastructure over these years.
Are there specific initiatives driving this, particularly for MSMEs and small businesses, to ensure they aren't left behind in this digital leap?
Absolutely. There's a focused incentive scheme specifically to promote low-value UPI transactions.
Making small digital payments viable.
Precisely. Making them appealing and viable for smaller businesses and everyday transactions. Guidelines for the TREDS platform, that's Trade Receivables Discounting System, have also been introduced.
And it's TREDS, right, for invoice financing.
Yes, to help MSMEs get invoice financing at competitive rates, which significantly improves their cash flow. And merchant discount rate, or MDR, rationalization on debit card transactions aims to reduce the cost burden on merchants, encouraging wider adoption of digital payments.
So, multiple efforts to foster an inclusive digital economy.
That seems to be the goal, yes.
That's a comprehensive approach to digital inclusion. Let's move to Section 3, other key financial developments that shaped July 2025.
Right, a mix of things here, from market participation to regulatory enforcement actions.
Okay, first up, we have a significant milestone from Gujarat. It has become the third Indian state to cross the 1 crore investor registrations mark on the National Stock Exchange, or NSE.
That's right.
Which states reached this achievement before it?
This is a truly notable achievement for Gujarat. I think it signals a broadening of financial participation beyond just the traditional hubs. It follows Maharashtra and Uttar Pradesh.
So Maharashtra, UP, and now Gujarat.
Correct. And these 3 states collectively account for a substantial 36% of the total investor base in India.
Wow, over a third from just 3 states.
Yes. And looking at the broader picture, the total registered investors in India reached close to 11.5 crore as of May 2025. That's an impressive figure reflecting growing financial inclusion across the country.
That's impressive growth. How does that investor base break down regionally? Does it give us a clearer geographical picture of market participation?
It does. Looking at the regional data as of May 2025, North India actually leads with 4.2 crore investors, showcasing strong engagement.
North India leading. Interesting.
Yes, followed by West India with 3.5 crore, South India with 2.4 crore, and East India with 1.4 crore investors. This geographical spread highlights the expanding reach of the stock market beyond traditional financial hubs, signaling increasing financial literacy and participation across diverse regions. A very healthy sign for the market, I'd say.
Definitely. Now, for a piece of news from the regulatory side that certainly sent some ripples through the market, SEBI, India's securities market regulator, has banned the U.S.-based quant trading firm Jane Street.
Yes, that was significant news.
What's the reason for this stringent action against a major international player?
Well, SEBI has barred Jane Street from India's securities market due to serious allegations of making unlawful gains through manipulative trading practices.
Manipulative practice only.
Jane Street, just for context, launched back in 2000, headquartered in the USA. It began its Indian operations in December 2020 and was registered as a foreign portfolio investor, an FPI, in India.
Right.
This ban really underscores SEBI's unwavering commitment to maintaining market integrity and taking stringent action against firms engaged in manipulative activities, regardless of their origin or size.
Sending a message.
Exactly. It sends a strong message that unfair practices designed to exploit the market simply will not be tolerated in India.
SEBI clearly taking a firm stand. On a different note from SEBI, they've also announced the VCF Settlement Scheme 2025. What's the purpose of this scheme and when is it effective?
Okay, this scheme, which became effective from July 21st, 2025, and it runs until January 19th, 2026. It's specifically designed to help venture capital funds, or VCFs.
Okay, VCF.
Settle violations related to their winding up provisions after they migrated to the newer Alternative Investment Fund, or AIF, regulations.
So a way to clean up old issues.
Essentially, yes. It provides a crucial opportunity for VCFs, whose liquidation periods have expired but are not yet formally wound up and, critically, still hold unliquidated investments to settle any pending regulatory actions.
What's the background here? Why did these VCFs face these challenges in the first place? Why the need for a settlement scheme?
Right, the background dates back to May 2012, when SEBI repealed the older VCF regulations following the introduction of the AIF regulations.
Okay, so a regulatory shift.
Exactly. And despite that, many VCFs face genuine challenges liquidating all their investments within the mandated tenure under the old rules. SEBI had provided an additional year for them to liquidate investments and wind up their schemes.
Right.
Once they migrated to the AIF structure, they could also enter a dissolution period after getting investor approval. The absolute last date for applying for that migration was July 19th, 2025.
Ah, so the deadline just passed.
Precisely. So this scheme is essentially a lifeline, an opportunity for those VCFs who didn't fully comply within the initial extended deadlines to sort things out.
Is there a specific tribunal where one can appeal against SEBI orders in such cases if a VCF disagrees?
Yes. The Securities Appellate Tribunal, or SAT, is the designated tribunal to appeal against orders issued by SEBI. It serves as an important check and balance in the regulatory process, allowing entities to challenge SEBI's decisions.
Okay. And what happens if VCFs don't avail themselves of this scheme despite the opportunity? What's the stick?
SEBI has been quite explicit about this. They stated they may initiate action after July 19th, 2025 against VCFs that neither completed winding up nor availed themselves of this settlement scheme. So there are clear consequences for noncompliance.
Right. Makes sense. And how is the settlement cost structured for these VCFs? How much does it cost them?
The settlement cost is tiered, seemingly to ensure some proportionality. There's a base amount of euro 9,000 for delays up to 1 year.
Okay.
with an additional €5 OTHI is added for every subsequent year or part thereof.
So it increases with the delay.
Yes. And furthermore, an additional amount between 1 lakh and euro OSLAC is levied, depending on the value of the unliquidated investments they still hold.
Tied to the remaining assets.
Exactly. And crucially, the settlement amount and all related expenses must be borne by the investment manager or the sponsor of the fund.
Not the investors.
Correct. It cannot be recovered from the scheme itself or its investors, ensuring that the investors are not penalized for these compliance issues.
That's an important protection. Now, here's some positive news about corporate responsibility. JSW Energy has been included in the FTSE4Good Index series.
Yes, good news indeed.
Why is this significant for the company, and is it part of a broader trend we're seeing?
Well, this inclusion is a significant recognition of JSW Energy's strong focus on environmental, social, and governance ESG practices.
ESG, right.
And their overall commitment to sustainability. The FTSE4Good Index series itself, developed by FTSE Russell, a major global index provider, specifically identifies companies with strong ESG credentials.
And JSW has made commitments.
Yes, JSW Energy has committed to achieving carbon neutrality by 2050, which is a significant environmental goal reflected in this inclusion. And is not alone. Tech Mahindra was also included in the FTSE4Good Index series, actually for the 9th consecutive year.
9th year. Wow.
Highlighting sustained strong performance in ESG. These kinds of inclusions really signal the growing importance of sustainable practices in global investment decisions. Investors are paying attention.
Definitely seems to be the trend. Okay, in market innovations, BSE, through its subsidiary Asia Index, launched the BSE Insurance Index.
A new sectoral index, yes.
What's the purpose of this new index, and how will it serve investors looking at the insurance space?
The BSE Insurance Index is a sectoral benchmark designed specifically to track the performance of listed insurance companies that are part of the broader BSE 1000 index.
So a subset of the BSE 1000.
Exactly. This provides a dedicated gauge for investors interested in the performance of the insurance sector, allowing them to easily monitor the collective health and growth of this specific industry, separate from the broader market.
Can you tell us more about Asia Index, Private Ltd, and the BSE 1000 index itself, just for context?
Sure. Asia Index Private Ltd is a wholly owned subsidiary of DSE Ltd, the Bombay Stock Exchange, which is Asia's oldest stock exchange, home of the Sensex.
Right.
As for the BSE 1000 index, it measures the performance of 1,000 of the largest and most liquid Indian companies within the broader BSE all-cap universe. So this new insurance index is a focused component, a specific slice of that much larger, well-established market measure.
Okay, got it. How is this new insurance index constructed? What's the methodology?
It uses a free-float adjusted market capitalization weighting method.
Free float adjusted. What does that mean for the listener?
Right, so free-float market cap is a method of calculating a company's market value that only considers the shares readily available for trading in the open market. It excludes shares held by promoters, governments, or other locked-in entities.
So it reflects the tradable market?
Precisely. This method also ensures diversification within the index, with a 25% cap per individual stock to prevent dominance by one or two large players. Its base value is set at 1,000, backdated to June 18, 2018, to provide historical context.
And how many companies are in it now?
It currently has 12 listed insurance companies as constituents, and the index undergoes semi-annual reconstitution.
What's reconstitute?
Reconstitution refers to the process of updating the list of companies, the constituents, in an index periodically, usually semi-annually, in this case June and December, to reflect market changes, like new listings or changes in market cap. This ensures it remains representative of the insurance sector over time.
Makes sense. Which are the top-weighted companies in this new index currently? Who are the big players?
As of June 2025, the top-weighted constituents give a good picture of the market leaders. HDFC Life Insurance is at the top with 25.19%.
Just over the cap or right at it?
Seems close to the 25% cap, yeah. Followed by SBI Life Insurance at 23.81%, ICICI Lombard General Insurance at 13.95%, Max Financial Services at 12.44%, ICICI Prudential Life Insurance at 7.37%, and LIC Life Insurance Corporation at 5.30%.
So dominated by the big life insurers mainly?
Predominantly, yes. This index offers a clear, detailed view into the performance of India's leading listed insurance players.
Okay, now, this next piece of news is genuinely exciting, I think, for individual investors looking to maybe dip their toes into real estate. Aurum PropTech has received SEBI's registration certificate for launching a small and medium real estate investment trust, or SM-REIT.
Yes, SM-REIT. a new acronym to learn.
And this is a first for a public-listed company in India. What exactly will this new SM-REIT offer?
This is indeed potentially a game changer for democratizing real estate investment in India. The AMSA SM-REIT, as it's named, will provide retail investors with fractional ownership.
Fractional ownership. Okay, explain that quickly.
Sure. Fractional ownership is simply a method where multiple investors co-own a single property, often a high-value one they couldn't afford alone. They share the costs and, importantly, the benefits, including rental income and any potential capital appreciation if the property value goes up.
So owning a small piece of a big building.
Essentially, yes. This makes high-value, potentially rent-yielding premium commercial real estate far more accessible to the average investor.
So what exactly are SM-REITs, and how did they come about as a new investment vehicle? What's the regulation behind them?
Right. SEBI issued specific regulations back in 2024, amending the existing REIT regulations from 2014 to specifically establish the guidelines for these small and medium REITs, or SM-REITs.
Focused on smaller properties.
Exactly. These focus on assets valued between 50 crore and 500 crore, a smaller range than traditional large REITs. Crucially, the SM-REIT framework also brings fractional ownership platforms, or FOPs, which were previously less regulated.
Right. Those platforms existed before.
Yes, brings them firmly within the SEBI regulatory umbrella, covering both commercial and residential properties.
So now fully regulated.
Fully regulated by SEBI. And the units of each SM-REIT scheme are required to be listed on the stock exchanges, providing transparency and, importantly, liquidity for investors who want to buy or sell their units.
And these are open to both Indian and foreign investors.
Yes. SM-REITs are allowed to raise funds from both Indian and foreign investors, potentially attracting significant capital. The amendments also formally introduce SM-REITs for both commercial and residential properties.
Residential, too. Interesting.
Yes, with fundraising starting from 50 crore for a minimum of 200 investors. This aims to channel capital into real estate in a regulated, transparent, and more accessible manner.
What are the specific requirements for the investment manager of an SM-REIT? SEBI must have rules to ensure they're qualified and committed, right?
Absolutely. To ensure these new SM-REITs are managed responsibly and ethically, SEBI has put in place some pretty rigorous criteria for the investment managers.
Like what?
They must have a net worth of at least 20 crore. They also need a minimum of 2 years of experience in real estate or real estate fund management. And importantly, they are mandated to retain a minimum of 5% of the total outstanding units in each scheme.
Skin in the game.
Exactly, skin in the game. For a period of 2 years, starting from the 4th year post-listing until the 5th year's end. This aligns their interests more closely with the investors.
What about leverage and governance?
If an SM-REIT uses leverage or debt, the manager must co-invest 15% alongside it, and leverage is capped at 39% of the REIT's assets. Governance is key too. At least half of the directors of the investment manager must be independent, and the trustee cannot be an associate of the investment manager, all aimed at ensuring good governance and investor protection.
Are there specific requirements for the properties themselves that an SM-REIT can invest in? What kind of assets?
Yes, there are. At least 95% of the SM-REIT's assets must be fully developed and, crucially, revenue-generating at the time of listing.
95%? That's high.
It is. It's higher than the 80% requirement for larger REITs. This provides more assurance of immediate income streams and stability for investors right from day one.
What's the minimum investment for individuals looking to get involved in these SM-REITs? Is it accessible?
The minimum subscription amount is set at 10 lakh per investor.
Okay, 10 lakhs. So more accessible than buying a whole property, but still a significant investment.
Definitely. And importantly, no unit holder can enjoy superior voting or any other rights over another unit holder within the same scheme, ensuring fairness among all investors. There are also strict timelines baked in. If a SM-REIT fails to make an initial offer within 3 years from getting registered, it must surrender its certificate and cease operations.
Use it or lose it.
Pretty much. Each SM-REIT scheme must have a distinct name and is explicitly prohibited from portraying guaranteed returns. The asset size must be between 50 crore and 500 crore, minimum 200 investors, excluding certain related parties.
And what about public ownership and related party transactions within these SM-REITs? Any safeguards there?
Yes, several. There's a requirement for a minimum public offer and allotment in each scheme of at least 25% of the total outstanding units, ensuring broad public participation.
Okay, minimum 25% public float.
And SM-REITs are strictly restricted from engaging in transactions with related parties, including contracts for things like facility management and property management. This is a crucial safeguard against potential conflicts of interest.
Right, avoiding self-dealing.
Exactly. Finally, special purpose vehicles, or SPVs, must directly own all the assets acquired by the SM-REIT scheme. The scheme itself must invest at least 95% of its assets in completed and revenue-generating properties through these SPVs.
So the structure is quite defined.
Very. These SPVs can only raise capital from equity investment, though they may raise funds by way of borrowings from the scheme of the SM-REIT. These detailed regulations really solidify the framework for a new, accessible, and hopefully well-governed way to invest in Indian real estate.
That's a very detailed and, encouraging picture for real estate investment access. Okay, next up, SEBI and the National Stock Exchange, or NSE, have introduced something called the Samuhik Prativedan Manch.
Samuhik Prativedan Manch, yes? What is this new platform? What does it do? The Samuhik Prativedan Manch is essentially a unified reporting platform. It's aimed at significantly streamlining compliance for stockbrokers.
Streamlining compliance? How?
It will provide a single window interface for stockbrokers to submit various compliance reports. This eliminates the duplication that often occurs when they have to submit the same information to multiple stock exchanges, like BSE and NSE.
Submit once, not multiple times.
Exactly. This platform is set to go live from August 1st, 2025. By centralizing reporting, it simplifies the regulatory burden for brokers, which should ultimately lead to greater efficiency in the market. Less paperwork, more focus on business.
That sounds like a welcome simplification for the industry. Now, SEBI and the stock exchanges have also made changes to the Enhanced Surveillance Mechanism, or ESM rules.
The ESM, yes.
These are for listed companies with a market value below 1,000 crore. When do these new rules start, and how many companies will benefit initially?
Okay, these new rules, which are designed to enhance market integrity and investor protection for smaller cap stocks, will start from July 28th.
July 28th, okay.
And it's anticipated that around 28 companies will initially benefit from these adjustments to the framework. The ESM itself is a framework to monitor unusual price movements and trading patterns, really to protect investors from excessive volatility or potential manipulation in these smaller stocks.
How do these new rules determine if a company enters or moves through the surveillance stages? What are the triggers now?
Well, to enter stage 1, companies showing a steady and significant rise in share prices over the last 3 months might be added.
Okay, sharp price rise is a trigger.
Yes. And to move to stage 2, which implies stricter surveillance measures, there's a check on valuation. A company's price to earnings, or PE ratio, must be no more than twice the PE ratio of the Nifty 500 index.
So a check against excessive valuations relative to the market.
Exactly, preventing potentially inflated stock prices from running too far without scrutiny.
What are the practical implications for a company once it's put in stage 1 of this mechanism? How does it affect trading in that stock?
Right, if a company's moved into stage 1, there are immediate trading restrictions. It must maintain a 100% margin from the T+2 day.
T+2, so 2 days after the trade.
Yes, meaning investors have to pay the full amount up front for any purchases, no leverage. Additionally, the shares will be traded under a trade-for-trade settlement system.
Trade for trade? What's that?
It means each trade is settled individually, delivery versus payment, without any netting of buy and sell orders. This, combined with a stricter price limit, 5% or 2% if a stricter limit is already in place, is designed to significantly limit speculative trading and bring more stability, or rather, curb excessive volatility. And there's also a weekly review mechanism built in. The company's status under ESM will be checked every week.
To see if it can move out.
Exactly. To decide if it can be moved out of the ESM list altogether, or perhaps shifted to a lower stage if conditions improve, like if the price volatility reduces or valuation comes back in line. Securities that complete 90 calendar days in the framework are eligible for a stage-wise exit, provided they no longer meet the entry criteria.
So it's not necessarily permanent.
No, it's dynamic. These mechanisms are crucial for maintaining market integrity and providing investor protection, particularly in the small cap segment, which can be more prone to volatility.
Okay, shifting to commodity markets now. SEBI has renewed the recognition of Multi-Commodity Exchange Clearing Corporation, Ltd., or MCXCCL.
MCXCCL, yes, the clearing arm of MCX.
And also approved electricity futures trading on MCX. What are the specifics here, and why is this important for the commodity market?
This is quite significant news for the commodity sector, particularly for energy trading in India. SEBI issued a notification approving the renewal of MCXCCL's recognition for another 3 years.
3 more years.
Yes, specifically from July 31st, 2025, running through to July 30th, 2028. MCXCCL is the clearing corporation responsible for all the settlements and risk management for commodity trades executed on the MCX platform. Its continued recognition is absolutely vital for the stability and smooth functioning of the exchange.
And the launch of electricity futures contracts. That sounds like a big development for the power sector.
It is. MCX received SEBI approval on July 8, 2025 to launch these electricity futures contracts, and they went live very quickly, just 2 days later on July 10th.
That was fast.
It was. Electricity futures are now available for trading for 12 calendar months forward, with the current month and the next 3 months open for active trading at any given time. This adds a crucial risk management tool for participants in the electricity sector. Producers, distributors, large consumers, allowing them to hedge against price volatility and better plan their operations and costs.
Is MCXCCL actually a part of MCX itself? And just for context, can you give us a sense of other recognized clearing corporations in India? Is it the only one?
Good question. Yes, MCXCCL is a wholly owned subsidiary of Multi-Commodity Exchange of India Limited, or MCX, so it's directly linked. And no, it's not the only one. SEBI lists several other recognized clearing corporations in India. Beyond MCXCCL, there's Indian Clearing Corporation Ltd, ICCL, associated with BSE, valid until October 2026. There's National Commodity Clearing Ltd, NCCL, linked to NCDX, valid until September 2025. There's NSE Clearing Limited, formerly NSCCL, linked to NSE, valid until October 2026. And AMC Repo Clearing Limited, ARCL, focused on repo transactions, valid until January 2026.
So a competitive landscape for clearing.
Exactly. This renewal for MCXCCL solidifies its important role within this diverse and active clearing landscape, which is essential for overall market stability and risk management.
It takes us smoothly into Section 4, Evolution of Banking and Financial Regulation. We have a few key updates here on how the rules are changing.
Indeed, highlighting the continuous adaptation of the regulatory framework, trying to keep pace with the market for stability and growth.
Okay, starting with the banking system itself, the RBI has included NSDL Payments Bank in the second schedule of the RBI Act 1934.
Yeah, NSDL Payments Bank, yes.
What does this status grant NSDL Payments Bank, and why is it significant for them? What changes?
This inclusion grants NSDL Payments Bank the prestigious status of a scheduled bank.
Scheduled bank? What does that mean practically?
Practically, for you, the listener, or for the bank itself, it means it now qualifies to access crucial RBI facilities. It can participate in the Marginal Standing Facility, or MSF, and the Liquidity Adjustment Facility, or LAF.
The RBI's liquidity windows.
Exactly, which are vital tools for managing short-term liquidity needs. It also becomes eligible for RBI accommodation, which significantly enhances its overall liquidity management capabilities and gives it greater stability and standing within the banking system.
And who's behind NSDL Payments Bank again?
NSDL Payments Bank is promoted by the country's largest depository firm, National Securities Depository Ltd, or NSDL, so it's backed by a major player. This move is a recognition of its growing role in the financial ecosystem.
Okay. Let's revisit the public sector banks, or PSBs, with an update on loan write-offs and NPA reduction. We heard the impressive figures on NPA reduction earlier. Can you give us the full picture now, including the significant write-offs involved?
Yes, it's important to see both sides of this. This is a crucial story of financial turnaround, but also involves significant balance sheet cleanup. PSBs have written off over 12 lakh crore in loans since the financial year 2016.
12 lakh crore written off? That's a staggering number.
It is. But alongside this, as we mentioned, their gross NPA ratio has declined significantly from that peak of 9.1% down to 2.58% by March 2025. That 2.58% gross NPA figure by March 2025 amounts to 2.84 lakh crore in actual bad loans remaining on the books, showing a remarkable improvement in overall asset quality despite the write-offs.
That's a massive amount of write-offs, though. What was the context for the NPA peak back in 2018, and how was it tackled so effectively to bring the numbers down?
Right. The NPAs peaked around 2018, largely due to an extensive and quite stringent asset quality review, the AQR, conducted by the RBI starting in 2015.
The AQR, right? That uncovered a lot.
It did. It brought many previously hidden or underreported bad loans to light. This peak was then systematically tackled through structured government and RBI efforts, most notably the 4R strategy of the government, which proves to be, well, highly effective over time.
And what exactly does that 4R strategy involve, again, as a framework for tackling such a large problem?
Sure. The 4R strategy stands for, first, recognition of NPAs, which was achieved through that AQR. You can't fix what you don't acknowledge.
Right.
Second, resolution of bad loans, facilitated by new mechanisms like the debt recovery tribunals we discussed, and critically, the Insolvency and Bankruptcy Code, the IBC.
IBC, yes.
Third, recapitalization of banks, providing them with fresh capital infusions from the government to absorb the losses from these bad loans and strengthen their balance sheets.
And fourth.
Fourth, reforms. Reforms to improve operational efficiency, risk management, and governance within the public sector banks themselves. And as a direct result of these concerted efforts, fresh NPA accretion, that's the rate at which new bad loans are being added, has dropped remarkably. It fell below 1% of standard advances in 2025. Compare that to 8.35% back in 2018.
Huge improvement.
Massive improvement. This demonstrates a significant strengthening of the PSB's balance sheets and lending practices.
Okay, here's news that will certainly benefit micro and small enterprises, or MSEs. The RBI has barred banks and NBFCs from charging prepayment penalties on floating rate loans given to MSEs.
Yes, this is good news for small businesses.
When does this come into effect, and how broad is its application? Does it cover everything?
This important directive will be effective from January 1st, 2026.
Nice, 2026. Okay.
And it applies to all floating rate loans given to MSEs that are sanctioned or renewed on or after that date. This means MSEs will have more flexibility in managing their debt, allowing them to refinance or repay early without incurring those sometimes hefty extra costs.
Does it apply to all types of loans, even things like cash credit or overdrafts?
Yes, it's quite broad. The RBI circular states no prepayment penalty will be applicable even in cash credit or overdraft facilities, provided the borrowers inform the bank or NBFC in advance and the facility is actually closed on the due date.
Are there any exceptions?
Yes, there are some exempted entities, small finance banks, regional rural banks, Tier 3 primary urban cooperative banks, state cooperative banks, central cooperative banks, and NBFCs in the middle layer category are exempted from this specific directive for MSEs.
Why the exemption?
Because these entities were already restricted from charging prepayment penalties for smaller non-business purpose loans up to 50 lakh. So this new rule essentially extends a similar benefit much more widely, specifically to MSEs for their business loans from the larger banks and NBFCs.
Got it. Okay, moving to how government payments are processed. A directive from the Department of Expenditure states that starting July 16, 2025, all central government payments above 75 crore must be processed through the RBI's e-Kuber system.
Yes, a shift towards centralized processing.
What does this entail, and how significant is this change in the threshold? 75 crore seems much lower than before.
It is a significant shift in government financial operations, aimed squarely at greater centralization and efficiency. This mandate includes payments to private parties, vendors, contractors basically, large government payouts covering various ministries and departments.
What was the old threshold?
Prior to this, the mandatory routing threshold for e-Kuber was initially unencumbered crore. So dropping it down to 75 crore is a substantial change.
Big difference.
Yes. Payments below Euro 5 crore will continue to go through the accredited bank accounts as before, but above this new limit, only e-Kuber will be permitted for central government transactions from July 16th onwards.
What exactly is the e-Kuber system? What does it do?
The e-Kuber system, which was implemented back in 2012 as the core banking solution, or CBS, of the Reserve Bank of India itself.
RBI's own banking platform.
Essentially, yes. It's a sophisticated platform used for critical functions like managing government funds, conducting auctions for government securities, and enabling real-time settlement and accounting for high-value transactions. Lowering the threshold to 75 crore significantly centralizes these high-value government payments, aiming for greater efficiency, transparency, and real-time reconciliation of funds. It brings more government spending under direct, real-time RBI oversight.
Okay. Now, here's an interesting clarification from the RBI regarding collateral for small loans. Banks can accept voluntary pledges of gold and silver for agriculture and MSME loans without violating the existing collateral-free lending norms.
Yes, the emphasis on voluntary is key here.
What is the key here? Why the need for this clarification?
The absolute key here is voluntary. The RBI clarified that while banks can accept such pledges of gold or silver, it must be offered completely voluntarily by the borrowers themselves.
No pressure from the bank.
Exactly. Banks must not exert any pressure or compel borrowers in any way to pledge gold or silver. Such truly voluntary pledging, the RBI says, will not be considered a violation of the established collateral-free lending norms, which are designed to support these vital sectors without burdening them with collateral requirements, especially for smaller loans.
Right. So what are the existing norms for collateral-free loans for agriculture and MSMEs that this clarification seeks to uphold? What are the current limits?
Banks are already advised by RBI to waive collateral security and margin requirements for agricultural loans, including loans for allied activities like dairy or poultry, up to 2 lakh per borrower.
Okay, 2 lakh for agri.
Yes. For the micro and small enterprises sector, the MSE sector, banks are instructed not to require collateral for loans up to 10 lakh.
10 lakh for MSEs, no collateral.
Correct. This also applies to loans under the Prime Minister Employment Generation Program, or PMEGP, administered by KVIC. Additionally, banks may extend collateral-free loans up to 25 lakh to MSEs that have a good track record and demonstrated financial stability, subject to their internal credit approval processes.
So this clarification helps ensure that genuinely voluntary collateral can be used, perhaps for larger loan amounts or better terms, without undermining the spirit and the specific mandates of collateral-free lending for these vital sectors up to those limits.
Precisely. It provides clarity for both banks and borrowers.
Okay. Now, the RBI has introduced new rules to limit how much banks and other financial institutions, regulated entities or EIs, can invest in alternative investment funds or AIFs.
Yes, this is about managing systemic risk exposure.
What's the aim here, and what are the new limits being imposed?
This move is a critical step aimed at reducing potential risks and improving the overall safety and stability of the financial system, particularly concerning interconnectedness between banks and AIS. The new rules cap the total investment limit by all regulated entities, combined banks, NBFCs, etc., in any single AIF scheme at 20% of that scheme's total funds or corpus.
20% total cap from all banks, NBFCs, in one fund.
Yes. Furthermore, each individual regulated entity, like a single bank or a single NBFC, can invest only up to 10% of the AIF scheme's total funds.
So 10% per institution, 20% overall from the regulated sector.
Correct. These new stricter rules will be effective from January 1st, 2026, or earlier if a financial institution chooses to adopt them sooner.
What happens if a bank or NBFC invests in an AIF, and then that AIF turns around and invests in a company that already owes money to the same bank or NBFC? This sounds like it could create a tricky, potentially circular debt situation.
This is precisely where the RBI is stepping in to address potential systemic risks and perhaps evergreening concerns. The rule states, if a bank or NBFC invests more than 5% in an AIF, and that AIF then invests in forms other than equity shares, so typically debt or hybrid instruments.
Okay, not equity.
In a company that already owes money to the same bank or NBFC that invested in the AIF, then the bank or NBFC must immediately set aside provisions equal to that specific portion of its AIF exposure.
Provisions meaning setting aside capital against potential loss.
Exactly. It's a crucial protective measure. However, this provisioning requirement is capped. It's only up to the amount of the loan or investment the bank already has outstanding directly to that company. It prevents an endless loop of provisioning, but forces recognition of the indirect exposure risk.
Okay, that's complex but important. And what if the investment by the bank in the AIF is in subordinated units? What are those, and what are the implications for the bank's capital then?
Right. If the investment by the bank or NBFC in the AIF is made as subordinated units, which are essentially a class of investment that has lower repayment priority in case the AIF faces liquidation, meaning they carry higher risks.
Last in line to get paid back.
Pretty much. Then the implication is more severe. The full amount of that investment in subordinated units must be deducted directly from the bank's regulatory capital.
Deducted from capital. Can you quickly explain provisioning versus capital deduction and Tier 1, Tier 2 capital?
Sure. Provisioning is like setting aside money from profits to cover an expected or potential future loss on a specific asset. Capital deduction, however, directly reduces the bank's core loss-absorbing capacity, its cushion against unexpected losses. Tier 1 capital is the highest quality core capital, like equity, while Tier 2 is supplementary capital, like certain types of debt. Deducting from these capital tiers for risky investments like subordinated AIF units directly impacts the bank's measured financial strength and its ability to lend or absorb further shocks.
So a much bigger hit for subordinated units. Which types of financial institutions do these new comprehensive AIF investment rules apply to?
These rules are quite broad, designed to fortify the entire financial system against these potential risks. They apply to basically all major regulated lenders. Commercial banks, including small finance banks, regional rural banks, and local area banks.
Okay.
Cooperative banks, all India financial institutions like NEVERD, SEBI, NHB, and non-banking financial companies, or NBFCs, explicitly including housing finance companies.
So pretty much everyone who lends.
Yes. This comprehensive approach aims to strengthen the entire financial system against potential contagion risks originating from concentrated or complex AIF investments by regulated entities.
That's a truly sweeping set of regulations, clearly aimed at de-risking. Now for Section 5, FinTech innovations and cross-border connectivity. The digital payments landscape continues to evolve at, well, a blistering pace.
It really does. It's an exciting area of growth and increasingly international expansion for India's payment systems.
First up, in a big win for India's digital payment system, Trinidad and Tobago has become the first Caribbean nation to adopt India's Unified Payments Interface, or UPI system.
Yes, UPI goes Caribbean.
Enabling far-out interface for money, or BHM, app transactions there. How significant is this, and what does it mean for global financial connectivity originating from India?
This is a major step, I think, in the global expansion of India's UPI network. It really showcases its growing international recognition and utility. Trinidad and Tobago is now the 8th country globally to formally enable UPI-based transactions.
8th country. Who are the others?
The growing list include France, which was the first European country, the United Arab Emirates, Bhutan, which was actually the first to adopt UPI standards for QR deployment way back in 2021, Nepal, Mauritius, Sri Lanka, and Singapore.
So a diverse mix of countries.
Very diverse. Each edition expands the reach and utility of this innovative payment system, making cross-border transactions potentially faster, cheaper, and more seamless for individuals and businesses engaging between India and these nations.
Are there other countries on the horizon for UPI adoption, perhaps in new regions like Africa?
Yes, absolutely. The expansion continues. Namibia is soon expected to become the first African nation to adopt India's UPI for real-time digital payments.
Namibia.
The NPCI, the National Payments Corporation of India, which of course developed UPI, signed a technology licensing agreement with the Bank of Namibia back in April 2024. The system is reportedly set to go live there later in 2025.
Shows growing international recognition.
It really does. Recognition of UPI's efficiency and potential. And just a reminder, the BHM app, launched in 2016 by NPCI, is simply a user-friendly payment application that enables simple, quick, and easy transactions using the underlying UPI framework. Its adoption in Trinidad and Tobago means potentially seamless, real-time payments for individuals and businesses interacting between the two countries.
Okay. Looking now at the domestic UPI landscape, PhonePe has retained the top spot on the UPI leaderboard for June 2025. No surprise there, perhaps.
Not a huge surprise. They've been dominant for a while.
What's their market share according to the latest data, and how do other major players stack up in this competitive space?
According to the data from the National Payments Corporation of India, PhonePe held a very significant 46.46% market share in terms of UPI transaction volume in June 2025, solidifying its dominant position.
Nearly half the market.
Almost half. Its closest competitor was Google Pay with a substantial 35.56% share.
So between them, over 80%.
Exactly. Followed by Paytm, much further back at 6.90%, then Navi at 2.21%, and an app called Super.Money at 1.19%. This clearly indicates a strong, persistent two-player dominance in the UPI ecosystem, at least by volume.
Are there any interesting trends regarding state-wise contributions or the top remitter banks? And does that give us a deeper insight into usage patterns?
Yes, there are some interesting points there. In terms of state-wise contributions to UPI volume for June, Maharashtra led the way.
Expected, perhaps.
Perhaps, followed by Karnataka, Uttar Pradesh, Telangana, and Tamil Nadu. This indicates the wide geographical spread of UPI adoption across major states.
Who's the banks driving this?
For the top UPI remitter banks, the banks whose customers are sending the most money via UPI SBI led the pack, followed by HDFC Bank, Bank of Baroda, Union Bank of India, and Punjab National Bank, mostly large public and private sector banks.
Okay. Anything else notable in that data?
Well, one interesting or maybe slightly concerning point is that 41.7% of the UPI transaction volume in June was categorized as unclassified due to missing location data in the transaction feeds.
Over 40% unclassified.
Yes, which highlights an area for potential improvement in data collection and reporting accuracy within the ecosystem.
Definitely something to watch. Okay, expanding further on cross-border payments. NPCI International Payments Ltd, or NIPL, the international arm of NPCI,
Yes.
announced the addition of 13 more Indian banks to the UPI PayNow cross-border payment system.
UPI PayNow connecting India and Singapore.
Exactly. How does this addition enhance the real-time remittance capabilities between India and Singapore?
This is a significant expansion that greatly enhances the ease and reach of remittances between the two countries. The UPI Pay-Now platform, as you said, is a joint initiative between the Reserve Bank of India and the Monetary Authority of Singapore, MES, designed specifically to facilitate seamless and instant cross-border remittances.
So adding more banks makes it more useful.
Precisely. With the addition of these 13 banks, the total number of Indian banks enabled for inward remittances receiving money from Singapore via PayNow has now increased to 19. This significantly broadens the reach of this real-time payment corridor within India.
And how can funds actually be credited to accounts in these 19 banks from Singapore using this system?
Funds can be credited to accounts in these 19 enabled Indian banks using various UPI-enabled apps familiar to users here, such as BHIM, Google Pay, PhonePe, or indeed the respective mobile banking apps of the participating banks.
Okay. And on the Singapore side?
On the Singapore side, DBS Singapore and Liquid Group are the key participants currently facilitating transfers to India on the PayNow network. The functionality allows for real-time cross-border fund transfers using either the recipient's UPI ID, their mobile number linked to UPI, or a virtual payment address, or VPA.
Making it much simpler than traditional remittances.
Absolutely. It significantly simplifies remittances for individuals and potentially small businesses between the two countries, making it quicker, likely cheaper, and much more convenient than traditional wire transfers.
Okay, finally, in fintech for this section, EximPay has received in-principle approval from the RBI for a cross-border payment aggregator, or PACB license.
PACB license, yes. Another important regulatory development.
What does this license enable for EximPay and the broader digital payments landscape for international trade?
This PACB license is a crucial authorization. It enables EximPay, once they get the final license, to process cross-border pay-ins, collections, and payouts, payments, for businesses involved in digital services, e-commerce transactions, and B2B trade, specifically focusing on emerging Asian markets in their case. This is a critical regulatory step for companies facilitating international digital transactions, granting them permission to handle the flow of funds across borders under RBI oversight.
Has RBI granted these full PACB licenses to other companies already, or is EximPay among the first?
No, RBI has already granted full final PACB licenses to 6 other companies prior to EximPay's in-principle approval.
Who are they?
The list includes 80 in India, Amazon Pay India, Cash Free Payments, BillDesk, Pay10, and Worldline ePayments India. So EximPay is joining an increasingly regulated and significant group of specialized cross-border payment providers.
Does RBI categorize these PACBs in any specific way based on what they do?
Yes, it does. The RBI categorizes PACBs into 3 types based on their function: export-only, PACB, import-only, PACBI, or both export and import, PACB-E&I.
Okay, depending on the flow of funds they handle?
Exactly. There are also specific net worth criteria they need to meet. For non-banks providing PACB services, as of the date RBI issued the circular back in 2023, they must have a minimum net worth of 15 crore when applying, and then they need to attain a minimum net worth of 25 crore by March 31st, 2026.
And for new players?
New non-bank PACBs, meaning those that hadn't commenced operations before the circular, need a minimum net worth of 15 crore at the time of application and must reach 25 crore by the end of their 3rd financial year after receiving authorization.
Who is the very first company to secure this cross-border license? Do we know?
According to reports, CashFree was actually the first company to secure the PA cross-border license under this new framework. It's important to note the regulatory requirement change. In October 2024, RBI mandated that payment aggregators facilitating cross-border payments must obtain this separate PACB approval. It's distinct from the previous Online Payment Gateway Service Provider, or OPGSP, license that some used to operate under.
So a tightening of regulations for cross-border payments.
Definitely. It emphasizes the heightened regulatory oversight specifically for cross-border financial flows, which carry unique risks.
Okay, that brings us to our final section, Section 6. Recent developments in financial sector regulation, offering a glimpse into upcoming changes and ongoing policy discussions.
Indeed, demonstrating the constant evolution of India's financial regulatory landscape, always trying to address new challenges and opportunities as they arise.
Let's look first at a key recommendation concerning the insurance sector. An RBI-appointed panel, led by Dinesh Kara, the SBI chairman,
Yes, a high-profile panel.
submitted its report warning against allowing mergers between insurers and non-insurance firms. What was the rationale behind this warning? What risks did they identify?
This warning is deeply rooted, as you might expect, in protecting policyholders, which is the core mandate of RBI, the insurance regulator. The panel cited potential risks to policyholders if insurers were allowed to merge freely with non-insurance firms.
What kind of risk?
They suggested it could dilute the insurer's primary focus on insurance business or create overly complex financial structures, conglomerates that might obscure risks or lead to conflicts of interest detrimental to policyholders. The Dinesh Kar-led panel, just for context, was formed back in February 2025 by RBI, specifically to review proposed amendments to the Insurance Act of 1938.
So their primary mandate was reviewing the act. Were there other broader reforms discussed or recommended by this influential panel beyond just the merger warning?
Yes, absolutely. The panel is also actively drafting a framework for implementing broader reforms aimed at developing the insurance sector. One significant recommendation reportedly being considered is allowing 100% foreign direct investment, or FDI, in insurance firms.
100% FDI. That would be big.
It would, but with a crucial caveat that these firms must retain the entire premium collected within India.
Retain the premium locally.
Exactly. This could potentially bring in substantial foreign capital and expertise, fostering growth and innovation in the sector, while simultaneously ensuring that the funds generated are reinvested domestically. It's an attempt to balance attracting foreign investment with ensuring the benefits accrue locally.
Interesting balance. Okay, finally, let's discuss SEBI's reaffirmation of KYC portability and the broader One Nation, One KYC initiative. Why is this back in the news, and what's the overarching vision here for you, the consumer?
Right. SEBI has reaffirmed KYC portability across securities, market intermediaries, stockbrokers, mutual funds, etc., setting what many hope will be a powerful example for other financial regulators like RBI and RBI to follow, pushing towards a truly unified and efficient KYC system in India.
And for the listener, what does KYC portability mean?
For you, this means significant potential convenience. The idea is, once your KYC, your Know Your Customer Identity Verification, is completed properly with one intermediary in the securities market, say, your stockbroker SEBI's rules explicitly state it need not be repeated from scratch when you go to another securities market intermediary, like a mutual fund.
Reducing repetitive paperwork and hassle.
That's the goal. Less friction when dealing with multiple financial institutions within the same regulated space.
How is this portability actually enabled in the securities market? What's the mechanism, and how does it compare to the central KYC registry, or CKYC, which many people might be familiar with from banking?
Good question, because the mechanism is different, and that's key. KYC portability in the securities market is efficiently enabled through SEBI's 5 dedicated KYC registration agencies, or KRAs.
KRAs. Yeah.
These KRAs actively verify and validate crucial data points like your permanent account number, PAR, and your address against official databases.
Verification is the key difference.
Yes. This is a crucial distinction from the Central KYC Registry, or CKYC, which is managed by an entity called CERSAI. The CKYC primarily functions as a central repository that simply stores the documents you submit.
It just holds this file.
Exactly. It doesn't actively verify the information in those documents in the same way the KRAs do. And this lack of active verification often leads banks and insurers to redo the entire KYC process themselves, even if your record exists in the CKYC.
Which defeats the purpose of a central registry somewhat. What exactly is CERSAI, the entity managing CKYC?
CERSAI stands for the Central Registry of Securitization, Asset Reconstruction, and Security Interest of India. It's a Section 8 company under the Companies Act, majority owned by the government, PSBs, and National Housing Bank. It was initially set up, as the name suggests, to operate a registration system under the Sarfisi Act, dealing with security interests in property. Over time, CERSAI was also tasked with running the Central KYC Registry under the Prevention of Money Laundering rules. The Central KYC Record Registry, or CKYCRR, which it manages, launched in 2016 and holds KYC records for customers of entities regulated by RBI, SEBI, IRDAI, and the pension regulator PFRDA. It also operates a portal under the BUDS Act with information on deposit takers.
So it has multiple roles. And what's RBI's current approach to KYC updates for bank accounts? Is it one-time or periodic?
The RBI mandates a periodic, risk-based KYC update cycle for banks. High-risk accounts require updates every 2 years. Medium-risk accounts need updating every 8 years. And low-risk accounts, think pensioners, farmers, laborers with basic accounts, only need updating every 10 years.
Okay, tiered based on risk profile.
Yes, attempting to balance compliance needs with customer convenience. And this whole drive for One Nation, One KYC is certainly gaining momentum, it seems. The government has stated its commitment to revamping the Central KYC Registry as part of its Budget 2025 proposals, possibly to make it more effective, maybe incorporating verification like the KRAs.
That would be a big step.
It would. Additionally, there's something called the eKYC Set2, a system put in place by NPCI to enable verification of identity by reporting entities regulated by RBI, using Aadhaar eKYC typically. The broader vision, clearly, is to create a seamless, efficient, and truly user-friendly KYC system across all financial sectors in India: banking, insurance, securities, pensions, reducing friction, cutting costs, and enhancing financial access for everyone.
A unified KYC, that would certainly be welcome. And that brings us to the end of our deep dive into July 2025's packed financial news agenda.
Indeed. We've covered a lot of ground.
We really have. We've uncovered the latest efforts in investor protection, explored the ongoing strengthening of our banking system, seen how fintech continues to reshape the way we transact, both domestically and cross-border, and delved into some significant regulatory developments.
Yeah, from those reduced NPAs and the streamlined MSME lending process using digital data, all the way to the global expansion of UPI and the strategic evolution of KYC norms. It's clear the financial landscape is continuously evolving.
Constantly shifting, always towards, hopefully, greater efficiency and security.
We certainly hope this deep dive has given you, our listeners, not just the facts and figures, but perhaps a deeper understanding of why these developments matter to you as a consumer, an investor, or simply as a citizen participating in the economy.
Because staying informed in this rapidly changing world isn't just about knowing what happened, but understanding the forces driving that change and, crucially, the implications for your own financial well-being.
Absolutely.
And as we consider all these sweeping changes in financial regulations, digital infrastructure, market structures, it does raise an important question, perhaps something to think about. In an increasingly interconnected and technologically advanced financial world, how do we strike the right balance?
The balance between
the undeniable benefits of innovation and efficiency on one hand, and the constant critical need for robust protection, oversight, and stability on the other. What new challenges might even arise from these very solutions we're implementing?
That's a great question. Balancing progress with prudence. What are the unintended consequences?
Exactly. Something to mull over as you go about your day.
We encourage you to keep exploring, keep questioning, and keep digging deeper into the topics that resonate with you from today's discussion.
Until next time on The Deep Dive, stay curious.